Lesson 15. Strategy portfolios and diversification. There is an old piece of investing advice that gets repeated so often. It starts to sound meaningless. Don't put all your eggs in one basket. But like a lot of cliches, it is a cliche because it is true. And in quant trading, it matters more than most people realize. Because when you've spent weeks tuning a single strategy and its backtest looks beautiful, the temptation is to throw everything behind it. This lesson is about why that is dangerous, and what to do instead. Why a single strategy is fragile. Let me show you with a concrete picture. Imagine you've built a trend-following strategy. It does well when markets move clearly in one direction, bull or bear. You run it across 2025, and it gives you 25% in the first quarter, then loses 8 in the second, gains 18 in the third, and loses 12 in the fourth. Add it all up, and you finish the year up about 19%. That is a real return, and most people would be happy with it. But look at the experience. 2 losing quarters, one of them double digits. The maximum drawdown hit 12%. If you were trading that live with real money, there would be weeks where you genuinely wondered whether the strategy was broken. And the truth is, in a sense, it was broken. Just not all the time. It was broken for the market conditions of those middle quarters. Now imagine, instead you'd split your money 3 ways. Half goes to that trend strategy. 30% goes to a mean reversion strategy, which is designed for choppy sideways markets, where prices bounce between levels, and 20% goes to a breakout strategy, which fires when prices punch through key levels. In that strong first quarter, the trend and breakout strategies do the heavy lifting, and you finish up around 17%. In the choppy second quarter, where the trend strategy lost 8%, the mean reversion strategy made 18%. After waiting, the portfolio is up about 1.8% for the quarter instead of being down 8%. You didn't lose money in a quarter where your main strategy was bleeding. Over the full year, the portfolio returns something like 20 or 21%, slightly more than the single strategy. But the maximum drawdown is around 3.5%. That is the part that matters. You've cut the drawdown by roughly 70% while barely giving up any return. The ride is smoother, the psychology is easier, and you are far more likely to actually stick with the plan through the bad months. That is the whole argument for combining strategies in one paragraph. You are not chasing higher returns, you are chasing similar returns with far less pain. What correlation really means? The whole effect I just described works, because the strategies aren't all doing the same thing at the same time. The technical word for that is correlation, and it is worth slowing down to actually understand it, because it is the single most important idea in portfolio construction. Correlation is a number between -1 and +1 that describes how in sync 2 strategies' returns are. +1 means they move together perfectly. When one is up, the other is up. When one is down, the other is down. 0 means no relationship at all. Knowing what one did tells you nothing about the other. -1 means they move opposite. When one is up, the other is reliably down. Now think about what you actually want in a portfolio. If you put 2 trend strategies together, both of them buying when moving averages cross and selling when they cross back, you might think you've diversified because they use different indicators. But if their correlation is 0.95, what you really have is the same strategy wearing 2 different hats. In a good quarter, they both make money and you feel smart. In a bad quarter, they both lose money, and you've gained nothing from the combination. The diversification is an illusion. Compare that to pairing a trend strategy with a mean reversion strategy. Their correlation might sit somewhere around 0.25. In a strong trending quarter, the trend strategy carries the portfolio, and the mean reversion strategy just sits there. In a sideways choppy quarter, the mean reversion strategy does the heavy lifting while the trend strategy takes small losses. The portfolio as a whole rarely has a terrible quarter, because the 2 strategies aren't likely to fail at the same time. That is actual diversification. As a rough guideline, anything above 0.8 in correlation is basically useless for diversification. You are just doubling up. 0.5 to 0.8 is weak, and you should be cautious about combining them. 0.2 to 0.5 is good territory. That is where most reasonable combinations live. Below 0.2, including negative correlations, is the gold mine. But it is rare in practice, because most strategies tend to make money in similar kinds of markets. How do you actually measure this? You run backtests of your candidate strategies over the same time period, export their daily or weekly returns, and compute the correlation between those return series. Python makes this trivial. A single function from NumPy or SciPy gives you the number, but the math isn't the important part. The important part is that you actually do it before you combine strategies instead of eyeballing it. And assuming two strategies with different names behave differently. How to split the capital once you've picked a handful of strategies that look good on their own and aren't too correlated. The next question is how much money to put behind each one. There are 4 common approaches, and they get progressively more sophisticated. The simplest is equal weight. You have $10,000 and 3 strategies, so you put about $3,300 behind each. It is blunt. It ignores the fact that one strategy might be clearly better than another, and it ignores differences in risk. But it is hard to mess up, and if your strategies really are similar in quality, it is perfectly fine. For beginners, I'd genuinely recommend this. The fancy allocation methods only matter once you have honest reason to believe one strategy deserves more weight than another. The next step up is score-based allocation. If you've been through the earlier lessons and built a scoring system that rates strategies, you can use those scores as weights. A strategy that scored 9 gets more capital than one that scored 7. The math is just dividing each score by the total. The appeal is obvious. Your better strategies get more money. The trap is that the scores are based on backtests. And backtests are rear-view mirrors. If a strategy scored 9 over a period that happened to suit it perfectly, you might be over-allocating to it just because of lucky timing. The fix is to rescore periodically rather than trusting a snapshot. The third method is risk parity, and this is where it gets more technical. Instead of giving each strategy equal capital, you give each one equal risk. A strategy with low volatility gets more capital because each dollar allocated to it contributes less risk. A strategy with high volatility gets less capital. The math involves volatilities and a target portfolio volatility. And frankly, it is overkill for most retail traders. If you are running a serious operation with enough history to estimate volatilities reliably, it is the professional approach. If you are just getting started, skip it. The fourth method, and the one I think actually suits most people, is core satellite. You split your capital into a big core and a few smaller satellites. The core, maybe 70%, goes into your best, most proven strategies, the ones that have survived out of sample testing and have been running live without surprises. The satellite portion, maybe 30%, is where you experiment with newer strategies you are still validating. The core protects your capital and produces steady returns. The satellites let you try new ideas without betting the farm on them, and over time a satellite that proves itself graduates into the core. Building a portfolio step by step, let me walk through how this actually looks in practice, because the concepts only click when you see them in order. Start with a candidate pool. You pull together maybe 5 to 8 strategies that each scored above 7 in your evaluation, each passed out of sample validation, and, crucially, span different types. You want at least one trend, one mean reversion, one breakout, and ideally something structurally different like a grid strategy. If your candidate pool is 5 trend strategies that all buy on moving average crossovers, you are done before you started. Then you compute the correlation matrix. Backtest each strategy over the same period, export the daily returns, and look at how every pair correlates. You'll usually find clusters. The trend strategies will all correlate highly with each other, 0.7 or 0.8, because they're reacting to the same market structure. The mean reversion strategies will form their own cluster. A trend and a mean reversion strategy will usually come out low, somewhere around 0.2 or 0.3. That is what you are hunting for. From the matrix you pick the combination. A classic choice, and the one I'd suggest as a starting point, is trend plus mean reversion plus breakout. The trend strategy handles markets that move clearly in one direction. The mean reversion strategy handles chop. The breakout strategy catches the sharp transitions. The correlations between them tend to sit in that good range, and historically that combination covers most market regimes. Then you assign weights. A conservative starting allocation for someone newer to this might be 50% trend, 30% mean reversion, 20% breakout. As you get more comfortable, you might shift toward more balanced weights or add a fourth strategy. The exact numbers matter less than the principle of mixing strategy types. Finally, you backtest the portfolio as a whole. This is the part a lot of people skip and shouldn't. Run each strategy separately over the same time range, then combine the results using your weights and the correlations between them. You are checking two things. First, what is the portfolio's expected return, which is basically the weighted average of the individual returns. Second, and more importantly, what is the portfolio's expected drawdown, which is lower than the weighted average of the drawdowns, precisely because the strategies don't all hit their worst periods at the same time. If the portfolio drawdown isn't meaningfully smaller than what you'd get from just running the single best strategy, your correlation assumptions were probably wrong, and the combination isn't doing what you thought. The rebalancing question there is one more piece, and it doesn't get enough attention. Portfolios drift. Say you start with 5,000 in strategy A and 5,000 in strategy B. 3 months go by. Strategy A had a great quarter and grew to 6,500. Strategy B had a quieter quarter and grew to 5,500. Your 50-50 split is now roughly 54-46. Left alone for a year, the better performing strategy could end up dominating the portfolio, and suddenly you've concentrated your risk in exactly the strategy that has had the most recent run, which is often the strategy most likely to mean revert. There are 3 common ways to handle this. The simplest is regular rebalancing, typically monthly or quarterly. On a fixed schedule, you move money between strategies to bring them back to their target weights. This is what I'd recommend for most people. It is mechanical and removes judgment from the process. The second is threshold rebalancing. You only rebalance when the actual weights drift past some threshold, say 10% from target. This reduces unnecessary trading and the costs that come with it, but it requires you to keep an eye on the weights and decide when to act. The third is to not rebalance at all, on the philosophy that you want to let your winners run and give more capital to the strategies that are working. This sounds appealing, and there are real traders who do it. But the risk is that you end up concentrated in whatever strategy had a hot streak, right before that streak ends. For most people, I think this is a mistake. The whole point of a portfolio is balance, and refusing to rebalance slowly abandons that balance. A note on frequency. More frequent rebalancing means tighter control over your weights, but more transaction costs and more tax events, if you are in a market where that matters. Less frequent rebalancing is cheaper, but lets more drift accumulate. Monthly is a reasonable middle ground for crypto, where costs are low and price moves are fast. Quarterly works for slower markets. The mistakes that catch people before we wrap up. Let me name the 3 mistakes I see most often, because avoiding them is half the battle. The first is over diversification. Some people hear that diversification is good and assume that 10 strategies must be better than 3. Each strategy you add brings monitoring overhead, and beyond a certain point, the correlations start creeping up, because there are only so many distinct market structures to exploit. A portfolio of 10 strategies tends to average out into something close to the market itself, with all the complexity and none of the edge. 3 to 5 well-chosen strategies is the sweet spot for most accounts. Below about $5,000 in capital, even 2 or 3 is plenty. There is just not enough money to spread. The second mistake is combining strategies that look different but aren't. 3 trend strategies, each with different entry rules, will often correlate at 0.8 or higher, because they're all reacting to the same underlying market direction. You think you have a diversified portfolio. You actually have one strategy wearing 3 outfits. Always check the correlation matrix before you trust the diversification. The third mistake is ignoring rebalancing. You build a beautiful 50-50 portfolio in January, and by December you check, and it is 75-25 because one strategy ran hot all year. The portfolio you are actually running no longer matches the portfolio you backtested. Set a rebalancing rule when you build the portfolio. Write it down and follow it. The discipline matters more than the specific rule. The takeaway, the thing I want you to remember from this lesson, more than any specific allocation or correlation threshold, is the mindset shift. A single strategy is a bet on one set of market conditions. A portfolio is a bet on the idea that, across enough different market conditions, at least some of your strategies will be in their element. The first approach is fragile. The second is robust. You are going to spend the rest of this course working toward live trading. When you get there, do it with a portfolio, not a single strategy. The returns will look similar most of the time, but the bad months will hurt a fraction as much. And the bad months are where this whole game is won or lost.